Alright, so this is the first video that I kind of want to do for everybody. Um, Basically, I just want to kind of give everybody a rundown of how to invest, what all goes into it. Um, there's so many different types of avenues you can explore, uh, and ultimately, of course, everybody wants to make money. So, anyway, my name is Blake. I've been personally trading in the market for probably around 10 years or so. So I'm no rookie to the game. Basically, I have a lot of different strategies that I know how to do and that I want to share with you today. And my first video here is just going to be like a breakdown of what the market even is. A lot of people don't even know what the stock market is, but ultimately, the stock market is basically it's a collection of markets where people are actively buying, selling shares of publicly held companies. Um, Essentially, if a company is public, for example, Best Buy. Best Buy is a public company. Um, there's ownership out there that people own of Best Buy, and basically, when Best Buy issues shares to the market, it's like a debt, and essentially, debt holders in the market own shares of that company. So, you know, um, there's a lot of reasons that companies do this. A lot of reasons that companies are public. Most of them are typically to raise capital for expansion or for, more than likely expansion or, basically allow ownership of shareholders. And a lot of things go into the stock market. So you have, mutual funds, you have ETFs. A lot of you with a 401k will have mutual funds in your 401k. Um, and mutual funds are, ultimately quote unquote safe investments. And it's a way of being diversified with smaller amount of uh, income or dollar amount. So, you know, for example, if you had the say you're looking to retire in 50-55, you could put money into what they call a target fund of 50-55, and $100 would go a long way. And an active money manager would manage your money and essentially move it around and diversify it for you within different stocks, bonds, um, all within that mutual fund. So, we all know when the market goes up and it goes down. Well, what a mutual fund does is kind of litigate some of your risk. And, when one stock's going up and another stock is coming down, kind of levels out to where you're over time, you should see an increase in your portfolio. Right now, everybody's seeing an increase in their portfolio. Market's as high as it's ever been, which could cause some concern too. So, but basically, we'll go through kind of what I see. So, um, obviously, if you can buy and hold, great. Buying and holding is the ultimate solution to stocks. When you buy something, you buy it because you think it's going to go up. Um, and by the way, I'm doing this on a complete whim. So I have no script, no nothing. Um, and I just left the gym, so if I'm a little red in the face or whatever, it's because me and B Weezy went hard in the paint. But anyway, we're gonna take a look at some of the basic things of a stock, and I'm gonna increase this on our screen here. This is Microsoft, and Microsoft is a stock that is in what they call the Dow. The Dow is a mixture of 30 stocks that are considered blue chips. So there's safe, quote unquote, investments, and over a period of time should grow. And over here on our right hand side on your screen here, you will see what makes up the Dow. Apple, American Express, Boeing, Caterpillar, Cisco, all right here. And by the way, the market is up 430 points. So what a day to kick off our our new pod, our new YouTube channel here. But anyway, there's ways to make money when the market goes up, obviously, and there's also ways to make money when the market goes down by hedging your investments and things. And I'm going to show you how to do it all. But first of all, you have to understand some of the things that go into the stock. So right in here, when we look at Microsoft, you have a market cap. The market cap is the overall value of the stock and the actual market is classified in. So for example, this stock here is in a sector of information technology. Industry is software. Sub-industry is system software. So the market cap is the number of outstanding shares that there's outstanding, which 7.6 billion outstanding shares in Microsoft. If you take 7.6 billion and you multiply it by the stock price of 178.56, you get your market cap. And that's essentially the overall value or how much the company is worth. The market cap class is going to be large cap. You've got small cap, got micro, got many different things that make up the actual market and different classes that stocks can be in. But this one here is a large cap. You've got beta. Beta's pretty interesting. Beta's kind of more advanced a little bit when it comes to the market, but essentially, if the stock's beta is 1.23, theoretically it means it moves at about 23% of when the market moves. So when the Dow is up 2%, it essentially moves the 2%, but then also moves a little bit higher. Higher the beta essentially is, it's more volatile, essentially. So it's, if it's 1 on the nose, it moves directly with the market, with the Dow. We talked about the shares, and we'll get into beta a little bit more. Beta is a little bit more of a technical term that's a little advanced, and you don't really have to worry about beta per se. You look at held by institutions. So this is held by millionaires, people with $1 million investments and above. 74% of Microsoft is held by millionaires. And essentially, with that number comes a lot of things. One of the biggest things that I look at is that 74% held by institutions. Well, typically institutional investors are not buying and selling every day. So if world came to an end, unless they started selling as well, which they could, a good, 26% of the shares that are out there that are outstanding are held by regular investors, you and I. And that's what makes the movement in the market. Now, don't get me wrong, and institutional investors do make different moves. Mutual funds do buy and sell daily. But a higher the institution amount, typically will mean that it's something that won't, tank or something. And the reason I say that is because I've seen it all. And I've seen some that have very low institutional percentages and they absolutely skyrocket and drop very dramatically. And they call those like pump and dumps. We'll get into those. So stay tuned. Um Essentially that's about all we're going to get into on the first part there, but I just want you to kind of understand what goes into each individual stock. And right now, if we took a look at Microsoft here, by the way, the market is absolutely screaming right now. It's up 461 points. 461 points means the Dow stocks overall average of all these right here is 462 currently. And ultimately today's a great day. Friday there was a major sell-off, was down 600. So this is like a recovery from Friday's sell-off. And if we take a look at where my mouse cursor is here, you have a bid and you have an ask. So the bid is the best price somebody is willing to buy. The ask is the best price that somebody's willing to sell. When these two come together, you make a trade. So I'll click on stocks here, click on our live data, and you'll see these stocks trades going through. Now, another thing you can look at is spread. The spread is the difference between the bid and the ask when it comes to the penny amount here. Now, Microsoft is at 2-cent spread. Big deal, right? Let's switch over to Tesla right now, which is one of the craziest stocks in the market right now. Look at that spread. $1.85, 81, $2.69. Wild spread. So that means the difference between the bid and the ask is the spread. Right now it's a little even, but it'll get a little wild in a minute. We might even place a trade on it here in a little bit. It's down from where it hit that high at about $9.55. $940. See that there. Well, let's go back to Microsoft. A little bit more of a safe investment, right? So, you have the open. This is where it opened at from the open of the market at 9:30 a.m. The high for the day. Yesterday's close, which shows it was 174.38. So if we add 174.38 plus 434, we'll get the number we're at today. And the overall low for the day. The size is the bid by the ask. When you see an increase in bid, typically that'll mean the stock is moving up. There's more buyers at that price versus sellers at that price. So we can keep an eye on it. 900s by 4 by 4, 8 by 8, 5 5, 6 2, 5 1. Get an idea if it's going to rise or not. And this is a minute chart. This is from the opening. Right here's the open, and you can see it's on a steady increase up. Right now, we all know what goes up comes down. And can you gauge and guess when it comes down? No, nobody can gauge it. But one of the things that you'll learn and realize is there's like a morning market, and this is a full disclaimer. This is all me. There's a morning market, which typically, obviously is open till around lunchtime, 11, 12. And then there's an afternoon market after lunchtime. And anybody out there that's interested in the stocks and stuff, what I want you to do is I want you to pick your favorite company. whether you like Apple, whether you buy things from the Gap, whether you have Sirius XM, whatever it is you like. And I want you to watch how it trades before you even get involved in this. That way you have an idea of, okay, the market's up 470 points, but your stock's only up, a few cents. Well, just know that the volatility of your stock is nowhere near where the market is. The beta is lower than 1, right? So let's just keep an eye on Microsoft. And the high for the day is now. 178.97 was the high for the day. When it pushes new highs, it usually runs through. So let's see what happens here while we watch it for a moment. 97 was the high. It's staying pretty steady. 97. It bounced off of it. 97. Got like a ceiling right there. 98. There we go. New high. Let's see what happens at the new high. Falling. Somebody's got a pretty big size order in there at that high, trying to take the gains for the day. You have multiple different types of investors that are trading in the market. You're gonna have day traders. Oh, pushing through 179.05. It's on its way to new highs, and we can see it here. Look at the jump in the overall there. Look at the volume down here. 87,000 that last minute. Let's see what the volume does around here. Pushing new highs. When it pushes new highs, it typically blows through those new highs. And it's doing it just like we showed. Just like we said. Making new highs. Look at the last 3 minutes. 178.76 to 179.20 and counting. And still counting. Once it creates its high, it will fall. And it'll fall down and level out to allow new investors to get involved. Let's see what it does here. Oh, okay. 179.22 seems to be like the high there. You can see that candlestick right there. Yeah. Falling down a little bit. What goes up has to level out and come down. It can't go to the moon. And ultimately, another one is Apple. And at its high was 317.29. So they all just kind of hit that high. And all kind of tumbling down a little bit. The market's up 472 points. Not much more it can go without any crazy economic news. And now, economic news is huge. And economic news is essentially market movers that control some of the things that get announced in the market. So there's like trade deficit, ADP employment reports, weekly jobless claims, non-farm payrolls, unemployment rate, consumer credit, wholesale inventories, creating new highs right now in Microsoft. So, a lot of you ask, well, market moves, X, Y, I can buy one share of Microsoft. Well, just going to give you a little taste of something called options. And as these things move up, this is $1.39 here on the last trade. Multiply it by 100, that's $139. 142 on the run. So that would be a $3 gain there in the last couple of minutes. Okay, now we're making 5. And let's see if it creates another high here to see if we can kind of show you how options, and that's primarily what I trade. And that'll be later on down. I'll probably make a video segment on options soon. Oh, $7 gain. Real quick. Real fast. And just this option here. And then if you go further in the money, which we'll get into all those techniques and stuff, later on, but now it's at $1.50 is the ask. You bought it at 139. You just made $10 in, I don't know, 35 seconds. So now we're making 12. Very, very quick. Very, very easy money. And going back to Tesla, this one here will be absolutely insane when it comes to options because of how much volatility this thing has. Right now it's at 887, and I don't want to get too far in detail in this stuff because, I mean, this is $4,000 investments in this stuff here. And look at the difference, 4,100 versus 3,975. I mean, it's $100 difference in the prices. Crazy. Absolute crazy. But it's on a heater. It's on a screen. I mean, the last, here's the last 5 days of this thing. 5 days ago it was $600. It's up $300. But let's go back to where we were looking here. Oh, $1.60. $160 you buy at 138. Ultimately made $22 in a matter of minutes here. Literally minutes with me on the investment. And that's kind of what I do, making $20 in a minute. Say you bought 7 of those. Now you're making hundreds of dollars. 7 of them to put you at about $1,000 investment. But you made about, what's that? 163 and 30, 164, and 38. You're making $26. Take 26 times 7. You're sitting at a little over $130, $140, which is over 15% in minutes. So options are a way to, 168 now. Still moving. That's $30. 32. $32 in the matter of the time that we were sitting here talking. And you take your gains, and you can see from 1035 to where we're at now. Look at that steady upstream. Straight increase. Options give you the ability to make money like people with a lot of money in the market can. So, the overall option may have went up $32, but the stock only technically went up like 45 cents or 50 cents. It's still going. If you had 1,000 of them, 50 cents, you're making some money. But if you only have, one, you made 50 cents. Well, you didn't make very much. And if you would have held it yesterday overnight, you make 3%. Well, 3% is a little shy. It's $5. Yeah, $5. But we just made, 36. So we'll get into options a little bit later. I mean, that's what I really thrive on, and that's what I want to kind of show everybody how to do. But I want to make sure that everybody has an idea of how this stuff all works before we get involved in the options. And I'll make an options video after this here so you can learn a little bit more about the calls and the puts, intrinsic value, time value, things that probably don't mean that much of anything to you right now. But we bought this at $1.38. It's now $1.79, $41 pretty quickly. We made that in the time of 3 minutes. And if you buy a lot of them, you make some money pretty quickly. So obviously this is good on days when the market is up. But what happens when it's down? Well, you can do the same thing on a down day with puts. I personally don't thrive on puts. I don't get excited over puts because who can really get excited when things are dropping? Even though you're making money, But in a bull market like we're in right now, very dangerous to try to trade those puts. And see here, now we're going to watch this thing fall when the market 2 minutes in, 179.80, now at 179.40. Look how fast this fell. So one of my biggest saying is you got to take your gain, and if you don't take them, it's hard to gauge when to sell out. Nobody knows when to sell out. But I can ultimately say that a $30 gain on $130 is pretty good. And you got to take gains when they're there. Now, again, if you took the gain here, you wait for the drop, you buy it again, and you do it again on a day like today when the market's up like it is. Great day to see the market how it is because there's a lot of volatility. A lot of things are up today after Friday's sell-off of 600 points. So, ultimately, watch this thing fall. We're at $20 right now. You would sell. You'd have to take your money. You just have to. And well, let's look at. I'm just curious to see what Tesla's doing. So Tesla was at 940 at its high here, and these options are absolutely out of the roof. But I just want to take a look at them without saying any words on what I'm looking at. But so that kind of gives you a little overview, and ultimately everybody has most people have a 401k SWPPX. That's one of the holdings. I want to get this right when I tell you what's in this fund. But for instance, the SWPPX. This is the Schwab S&P 500 index fund. So what that means is, and notice there's no options on this because this is a mutual fund. But basically, you'll see no movement. Doesn't move at all. Market is absolutely moving up. This is no movement. Mutual funds trade once a day. That's it. So all the gains that we see today are not showing in this mutual fund. This is yesterday's close. Yesterday market was up, so it was up 36 cents. So after a day like today, it'll probably be up like $1 or so. But this is where your 401k could be invested in. And ultimately, I'm just looking on the internet, though. It's got Apple, Microsoft, Amazon, Facebook, Berkshire, Class B, JP Morgan, Google, Johnson & Johnson, Visa, Procter & Gamble, AT&T, Bank of America, and etc. The Schwab S&P 500 index follows the S&P 500. And over time, this should essentially grow. And they pay dividends, or maybe they don't pay dividends, and dividends are essentially money that in this case the money manager would pay to you for owning the index fund, and then you can reinvest your dividends. So instead of doing a cash into your account, it could buy more shares of the index fund when it gets issued. It could be issued monthly. It could be issued quarterly. It could be issued yearly, annual. So let's go back to Microsoft, just so you can see. Look at that, $144 multiply it by 100. That's $142. We bought it at 138. Look at that fall. Now we're back even. So at the peak, man, oh man, you gotta sell. You have got to sell. And that's what a lot of people will struggle with, is the actual selling part of the stock in the option. And knowing when to sell because nobody actually knows. But you've got to have an exit strategy before you get involved with day trading. A loss strategy if it's not going your way, and a gain strategy when it is. And keep in mind, if you do not have $25,000 in assets with a firm, you are not able to do unlimited day trades. You can do 3 within a 5-day rolling period. And if you do more than 3, you'll be classified as a pattern day trader. You may get a phone call to ask you to bring in 25,000. Most of the time, they give you a slap on your wrist for your first time, but you definitely don't want to go past that. They'll restrict your account. So, ultimately, if you're looking to get involved in options, which is something we will look at completely different, like I said, just know you can only do 3 in a 5-day rolling period. So what does that mean? You trade options when you're going to make money, like a day like today when the market's up 400 points. You wait for days like today, or wait for sell-offs like Friday. You don't trade it every day if you're not able to buy and sell. Because essentially, if you would have bought right here at the 1035, sold at the 1047, and made that $45 gain that we had, you just do it again when it comes back up. But and that's a pretty good trade. You're making over 30%. Not bad returns. But there's a lot of more things that go into it, and I'll get into them later. But I really just wanted to kind of go over the reason for the stock market. And a lot of you may not even realize that the stock market actually controls everything when it comes to the economy. There's when interest rates recently have been increasing, and that is signs of a good economy and signs of good consumer indexes and signs that consumers are making money. And 3-4 years ago, you were making 0.01% on your savings account with any bank you had. So you weren't even outweighing inflation, which is essentially the increase in goods that bread, water, gas, stuff like that. So as time goes on, those prices go up 0.01%. Your money even is not even in line with inflation. So a lot of people move to the stock market, when that's the time. And when interest rates increase, also, people tend to maybe even pull out of the stock market. Oh, and I just want to show you something here. That big candlestick went to 180 real fast. Major action on the buy. Major buyer. And the way this happened is somebody went in and said, I want to buy 100,000 shares, and I'll buy it at a limit order of 180. And they went through immediately. And people on the other end have what they call like sell limits, to where if it hit 180, they would sell. And those are the ones that put those trades in that maybe can't watch it all day, or want to take gains at 180, or willing to sell out at 180. Well, this guy here, whoever this was, money manager or a single person, just bought everybody's share that went to 180. That's just a very interesting thing to see, that big candlestick there. The market never really reached that point, but somebody put a mass order in to buy. So what does that do to our option? Check out that option. It's now at 157. Went down to 142 a moment ago. If you could buy back in at 142, you could now sell at 157 right now. Not much of a gain, but it's a gain. And if you buy multiple, you can make money on that gain. very quickly. And in order to do that unlimited amount of time, you just need to have $25,000 under investment. That could be all of your accounts. Now it's at 163. We would have bought back in at 142. Now it's at 166. To gain almost $30 again. And all I did was buy here, made $45 an option, which if you buy 10, you make 400 or you make about $400. Sell out, buy back, sell out. You can make some money. You can make a lot of money doing this. But just keep in mind, in order to do so, you have to have 25,000 under asset management. So a lot of you will go, well, I bought here, but I didn't want to sell here because I wanted to make more money. Pigs get slaughtered. Sell out and just close out the app. Close out your investment portfolio. Don't look at it anymore. It'll make you sick. It will absolutely make you sick if you don't guess when to sell out. But you take gains. You got to take your gains. And I really wish I could show you the gains in a stock like Tesla. I mean, thousands of dollars are being gained in Tesla by the minute. I mean, earlier today, on this drop to 833 to 939. By the way, there's no way to tell how much money you would make on an option without owning it and knowing and watching it, because there's a lot of factors. There's time value, there's momentum, there's if it's in the money, when's it expire, what's the intrinsic value. There's a lot of things that go into it, but I can give you an idea that at anybody that bought at this price here at 937 and sold it at 950, well, give you an idea of somebody that did that right here. The high, it opened up at 47.08. The low went to 18.50. Keep in mind that's times 100. So $1,800 was the low. That would have been right here. Somebody buys in at $1,800 and sold it at $8,800. $7,000 profit in 37 to 51. 10, 12 minutes, 15 minutes. And that's the name of the game right there, is how options do that. Now, options are fun. Options are fun. It's like gambling, but you make money, you trade with the market, and that's what we're all about. I trade with it. I don't guess it. I don't want to hold overnight. Anything's possible overnight. We all know what can happen overnight. The coronavirus out there, it could really mess things up, and people sell off because of the coronavirus. The market's up 432 points. Given history, it should be down tomorrow. So if you don't take your gains today, don't think there's gains tomorrow. That's another thing too. So day trading allows you to maximize value of your portfolio the day of. Now, yes, let's look at Tesla again. If you were one of those lucky people that held it for the last 3 days and got in at 640 and sell around 900, wow. You talk about $70,000 of gains, no matter what option you had. That's insane. Insane, but it is accurate. It would have been $70,000 of investment gain. Now, in order to trade something like this, you have to be able to put up risking of about $1,800. But if you could turn $1,800 to $70,000 in 3 days, would you do it? Gosh daggone right. I wasn't lucky enough to do that, but like I said, you buy and sell same day. That way you are not on edge overnight. But lately, Tesla just doesn't care. It's on its way to a millions and gazillions. I don't know what it's going to do, man. It's nuts. But essentially, I want to kind of wrap it up because I'm going to go in a little more details on my next video um, on options and what they are, how to trade them, what's the risk involved, because obviously there's risk involved. What's the max loss? What's your total gain? What's your max gain? And a day like today is a good day to look at it. And essentially coming up on the 11 o'clock hour, if the stocks are trading like I've seen in any other day, typically they'll start leveling out, maybe dropping between now and about 1 o'clock and pick back up to where they were. And you might get a good buying opportunity midday. So I guess I'll just keep this video broadcasting going. This is our first video, and I plan on doing more. So definitely, if you enjoy the content or have any questions, please ask me. I'd be happy to help, and that's the reason I'm doing this in general. I want to help people, and basically show you how people are making money in the market when people say you can't beat the market. If you hold long term, you beat the market. If you buy when it's down, you beat the market. When the stock market crashes, if you buy, you're buying everything on sale, it gets up to where it is, you beat the market. That's the Warren Buffett technique. Everything's on sale. Buy. Overall, buy low, sell high. If it was that easy, everybody would buy low, sell high. But it's not that easy. It is not that easy. You can't gauge where it's going to go. There's no way to do that. But just always remember that when you do have gains, when you are making money, and you're happy with it, sell. Move on. It's not a sprint. It's a marathon. You're going to be doing this, and I'm going to be helping you for a long period of time. And there's no point in trying to rush it or trying to chase it. You wait for days like today, and I'm sure tomorrow's content's going to be a little bit different than what we've seen today, but probably not. There's ways to make money on both ends of the fence. Now, we're still watching it, 157. Check that out. Right here is the 180 strike price. Okay. What does that mean? Well, let's go into detail of why these things even exist. Why are options available? Why can't I just go buy the stock? I don't need to buy these options. Well, there's multiple reasons that they are available. And hedging, which hedging means essentially if you're losing money, say you bought it at, well, you can't lose money because it's at another high, but let's say, for instance, you would have bought this stock at $200 and it's down to $179. You can trade these options to hedge your bet and make money on the loss of your shares. We'll definitely get in that in a different video because that's a video in itself. And that's the reason a lot of people trade these things. But this dollar amount of 180 right here is called a strike price. That is your contract agreed price. And essentially what that means is if you're a buyer of the option, you have the right to sell your shares to the seller of the option at that 180 strike point. Whew, probably just blew everybody's mind. What the heck does that mean? Okay. So, the 180 strike point, we're at 179.34. It's not even at 180 yet. But there's time. Right here is the time. We have until February the 7th, which is Friday. All options expire on Friday. Some options only trade monthly. A lot of the big ones trade weekly. But somebody out there thinks, yeah, I think it'll go way past 180. and I'm going to be able to buy this contract to buy these 100 shares at a discount. So the options are out there because somebody wants to buy Microsoft at $180, regardless of what the option or regardless of what the stock price is at in the market. The only way they benefit is if it goes through 180. If it doesn't go through 180, they wasted some money. Now, whoa, right? So why would somebody pay $152 right now for something that's agreed upon above where it was at? Because the anticipation, the movement, the volatility, how fast it's going up. They think I'm going to pay $150 and get this thing at a discount. And then I'll immediately sell it in the market if I want to. So you have something called a buyer of a call, which a buyer of the call wants it to go up. Because essentially the buyer of the call option is going to buy this stock at $180. Now, I know earlier you could sell the contract, buy it at 138, sell it at 175, make that money, but that's trading the contract. That's something that I do. I have no desire of buying 180 shares of Microsoft at $180. $18,000 in Microsoft at the expiration price. Nope. I'll buy it at 138, buy 10 of them, put 1,000 up, and make $400. I'm happy. Now, if I wanted to, and it went through the roof, I could cash in my option and make some money. But check out that run from time 11 to now. 166. It was just 150 something. That's another $10. This is a day trader's dream. Look at that. Buy it, sell it. Buy it, sell it. Buy it, sell it. Making money. And if you're able to day trade it, just on the last 40 minutes, and I say if you're able to day trade it because you have to have $25,000 in investments in order to do it multiple times a day, all the time, boom, 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 boom. Essentially, 40 here, 40 here, 40 here. You just made $200 on $100 and something investment. That was always at risk. So you put up $300 at risk, made $300 in gains, 100% gains in 40 minutes. Pretty easy, right? Well, that's what I'm here for. I'm going to help you see how it actually happens. But essentially, let's get back to where we're at. The seller of the call wants it to go down. The buyer of the call wants it to go up. The seller of the call wants it to go down. The seller of the call wants it to end worthless. Okay? Why? Well, when the buyer of the call buys it at $167, the seller of the call gets that money as a premium in their pocket. Boom. I pocket that money. And when this does not go to 180 by Friday, I pocket that money. No foul. So the seller of the call wants this thing to go down. The buyer of the call wants it to go up because he's going to buy the shares at 180, sell them immediately at the market at whatever the gain was. So that's a big reason of what they're around for, is because it's kind of like guessing where the market's going to go. And a day like today, these things are kind of expensive because of how much it's already up. But let's go to the biggest reason options are around. Options are around for income generation. For example, Say you own 100 shares of Microsoft in your portfolio. You have 100 shares of Microsoft that you bought. Who cares when you bought them? Say you have 100 shares of them. And what you want to do is you're going to scroll down here. Check that out, 190. It's not a good one. Let's go 185. 185. $41. So each week, a day like today, not a good day to sell your options on your shares because it's up so high. Keep an eye on that 180. Look at that. 180, you would bought it at 138. You sold out about a 180 if you would have held through this drop, or you buy it, sell it, buy it, sell it. Look at this run. It's going to go through that 180 price point. This thing's going to go up to $200. And you bought it at 138, sold it at 200. You literally just made 70% gains on $138. No risk. The market's moving. Watch it. The market is moving. The market's doing it. There's no risk. At 185. Look at that. Boom, boom. Okay. Back to what I was saying. Say you own 100 shares of Microsoft and you want to generate income. So you're going to sell. If you think it's going to go up, you sell puts. If you think it's going to go down, you sell calls. Whoa. So you buy a call, it goes up. You buy a put for it to go down. You sell a call, you want it to go down. You sell a put, you want it to go up. And I'll explain that in the best terms that I can. The buyer of the call is going to buy these shares at the agreed price at 180. So the buyer of the call wants it to be above $180 because he's going to pay $179 to get this at like 185 by Friday. He's making money. He's buying 100 shares at 180 regardless of what it's trading for in the market because he has a contract for 180. So when Friday or tomorrow or today, doesn't matter when, as long as between now and the expiration date, he can buy those shares at that strike price as long as it's in the money. So the seller of that call wants it to go down because he wants to keep his shares and keep your premium, the money you paid to buy this option. Income generation. When it expires, worthless. Now, on the other side of it, you buy a put when the market's going down, you buy puts, and it moves exactly how these calls are moving. I would show you, but everything's completely too high to show you. But I will show you one of these days, probably tomorrow when the market drops because it's way up. So the buyer of the put wants it to go down. The seller of the put wants it to go up. The reason being is because of what they call in the money. When you buy a put, you want it to go down. When you sell a put, you want it to go up. Because if it goes up during selling of the put, it's not in the money. They can't execute. They cannot buy those shares from you, and you keep their premium. Income generation. And this is how people with money make more money on their investments each week, every week. There's virtually zero risk to trading options when you own the shares. When you own the shares, worst case scenario is that you deliver your shares at 180 to this person. You keep their premium. You keep $175. You deliver your 100 shares at $180. So you take $175 plus $18,000 goes into your cash. They buy your shares that you personally have, and you take that cash and do something else with it. That's the worst thing that could happen. That's it. If it doesn't happen, you keep his $172 each week and you keep doing it. And you keep doing it. So that's why when you own shares, you need to be selling options on your shares. If you have questions on that, please ask. I will help you. I'll give you another example. Let's go to something a little bit cheaper. AMD. Weekly options. Let's say I own AMD. I bought it at $30 a share. I own 100. $30 a share. $3,000. I'm going to sell options on my 100 shares that I personally own at these given strike prices right in here. We could go even way out of the money. Or I'll tell you what. Let's go with, most of the time, people trade options monthly. And this is typically 221 it's the third Friday of every month is the monthly options. And this is where you'll see the most volume and the most open interest. Volume is the day volume, what has been traded, bought, and sold today. Lots of them today. Open interest is how many there are after yesterday's close. Okay? So let's say if you knew about AMD, and AMD just announced earnings, I'm going to scroll out a little bit. People didn't like it. AMD was just $50.59. The next day it opened up at about 47. That's a pretty big drop for AMD. Now, if you've been following AMD, you also know that this stock is up a tremendous amount. Let's go with, let me find one of my stocks here, or my chart that can show us the last year, 2018. $10 a share. Okay, 2019. $18 a share a year ago in January. So it's up $30. So if you've been following this, you've been making some money. So you knew it was time for a pullback, right? So let's go back to AMD. Let's go back to our options. Let's go back here and boom. Okay, you bought 4 months ago. You got AMD at $30 a share. You bought 100 shares. It was $3,000. Cool. Now you want to sell options on your 100 shares to gain income, to gain revenue, to gain guaranteed money. Literally guaranteed. There really isn't a risk to this except for delivering your shares at this strike price. That is it. Maybe a taxable event, depending on what type of account you have. So if it's like a brokerage account, you may have a taxable event, pay Uncle Sam a little bit of money. But anyway, let's take a look at this. Let's go with the $80. Okay. All right. I think the market will drop tomorrow. So I think I'm going to sell options today. I'm going to sell a call. Because when you sell a call, you don't want it to go to your strike price of 51.50. Because if it does, the buyer of your option can buy your 100 shares at 51.50. Worst case scenario, he buys your shares at 51.50. That's a $21.56 gain on each share. That's a $2,100 gain on your $3,000. You made, what's that? 70%. And when it doesn't happen, you keep his premium of $100. You can do that every single week. Every single week on a $3,000 investment, $100. This is a monthly one here. So let's do $100. So $3,000 investment. I'm pulling out my phone here to do some math. $3,000. Let's say you can do $100 of income generation guaranteed a month for a year. That's $1,200. So let's take 1,200 divided by 3 grand. That was your initial investment. It's 40% annual that you'll make on this investment at zero risk. Worst case scenario, you deliver your shares at 51.50 that you bought at 30. You go back in the market, you buy 100 more, you do it again. There is no risk. When you own the shares, there is no risk. Now, let's look at a company like Apple. No, that's better yet. Disney. I love me some Disney. Apple's still kind of expensive. We're going to look at Disney. Weekly options. You can make some money on Disney weekly options. Disney's currently trading at $144. Let's say you bought Disney at $100. Okay? So, Disney, $100. You bought 100 shares. That's $10K investment. If you have more than 100 shares, you can sell more options on your shares. And these are your shares. There is no risk, okay? Zero risk here at all. Let's say you want to sell options. Currently, it's trading at $144. You think by Friday it won't go above $150. That's $6 more. The likelihood of that happening? Probably not. Let's say you sell one contract. Right now it's $227. Somebody out there will give you, the owner of the shares, $227 for the bet that it goes above $150. $6 in 4 days, I'll take it. This is weekly, by the way. This is weekly. So let's just say you sell this option. You got $10,000 involved because you bought it at $100. $10,000 on the line. You take the 228. So let's do 10,000 divided by 228. It's about 3% weekly. Let's do some more math. 228 times 52. That gets a little out of hand, but it happens, and I can promise you it happens. That's 12 grand on your $10,000 investment. You're making over 100% annually on doing this with zero risk. Literally zero risk. Okay? So, let's say, worst case scenario, it does go to 150. Let's say it goes to 150 tomorrow. Shoot. He wants to buy my shares. All right. So you take 150 times your 100 shares. That's 15,000. You bought it at 10. You have a $5,000 gain. Plus, you keep his 228. So you basically make $5,228, and then you just go buy another 100 shares of Disney. Worst absolute case scenario. This thing goes through the roof tomorrow. It goes to 170. Okay. Here is your risk. You do not gain. You do not make the money on the 170, which would have been 170 times 10 or 100 shares, 17 grand. you miss out on $2,000 of gains if it was to go up $20 by the end of this week. Disney has never went up $20. It's not a volatile stock. It doesn't do that. It's not going to happen. But if it did, you would still make your $5,200 on your 10K investment. And instead of taking that money and going and buying Disney again, you may buy something else. Because you wouldn't want to buy it at 170 because now you're losing 2K. You'd wait for it to come back and then buy it. There is zero risk at selling options on stocks you own. For example, Ford. Ford is a very slow moving stock. Very slow moving stock. Let's say you own 1,000 shares of Ford. So a $9 stock times 1,000, $9,000 investment. This is very doable. Let's say you want to, Ford does not move at all. The market's up 500 points and Ford's up 18 cents. Wow. No worries here, right? If you own, 100 times what I say. 900 shares. No, 1,000. You own 1,000 shares. If you own 1,000 shares and you were to sell these options at, $21, 21 times 10, $210. When's the last time Ford's made you $210 even on a $10,000 investment? Probably never. Worst case scenario, you've delivered your shares, you make the money, you make the 210, you go buy it again. No risk, folks. Let's look at another one. A lot of people own Bank of America. That's a good one. Very good stock. Doesn't move very much. On a day like today, market's up 475 points. It's up 80 cents. Whew. Cool. So let's say you own 1,000. Let's say you own 1,000 shares of Bank of America. 1,000 shares of Bank of America. You got $34,000 invested in Bank of America. You can sell options on Bank of America to not go above $35 by the end of this week for $37. Take 37 times 10, $370. So you can take $370 divided by your 37,000. 370 divided by 37,000. Each week. So I want to make another video because I want to show you this without the information before my video. And I'm going to end this video and start another one after I take a shower because I just went to the gym. Very hot in here. And I need to take this sweater off and all that stuff. So bear with me, folks. If you like the content, please subscribe. Please comment. Please let me know questions that you may have. I'm definitely here to help. But what I'm going to do is I'm going to let lunchtime take a toll. Where's Microsoft? Did it go through 180? Nope, not yet. Okay. Let's let this trade a little bit. We'll come back. We'll start doing a little bit more on what they call covered options when you own the shares, income generation, what people do to make money weekly, to make crazy gains annually on money with absolute zero risk. We'll be right back, folks.